Welcome everyone. This is chapter 12. In this chapter, we'll learn about social insurance and a new function of government. We'll start with government's role in the insurance markets, and we will also talk about why we actually have insurance. Why do we buy insurance, right? Car insurance, health insurance, life insurance, all those things. Let's get started. So in part 1, we will talk about the government's role in insurance markets. And let's get started without further ado. This is our GPS of our chapter. What is insurance? Why we value insurance? Number one. Why do we have social insurance? So why is government in the insurance markets? Social versus self-insurance. We'll talk about something called consumption smoothing. Also, problem with insurance. We'll talk about moral hazard problem, and we're going to put everything together, and we'll talk about the optimal, the best level of social insurance provided by the government. Let's get started. So this is the government spending by function between, for instance, 1950s and late 2010s. So if you look at these, pie charts, 53, 2019. So if you look at, for instance, disability and unemployment, right? 4.99%, 4.6%. It kind of stayed a similar rate. And then Social Security, 3.55% in 1953. If you look at Social Security, it's gone up to 18.3% these days. Health was 0.53%. Now it's 24%, almost 24% of government spending. And other spending group has gone up. Defense is a percentage of government spending was 70%, almost 15%. Of course, remember this defense spending, right, today or these days is much more higher than the defense spending back in the day. But we are talking about its relative place in the budget, in the government budget. So government today devotes much a larger portion of its budget to social insurance than it did 70, 80 years ago. Okay. So we are going to talk about some important social insurance programs in this chapter. We'll talk about Social Security, unemployment insurance, disability insurance, workers' compensation, and Medicare. So Social Security is for the old age. You work all your life. Government takes a deduction from your salary, and once you, I was going to say graduate, once you retire, you collect Social Security benefits. Unemployment insurance is also taken out of your paycheck, payroll, if you're a payroll employee. And if you become unemployed, again, government has unemployment insurance. For instance, unfortunately, someone I know lost their job in California. And what happened was that California government and federal government, there are some social insurance programs, right? Replaces about 40 to 50% of the income. So they are not finding themselves in an extreme condition. Okay. Disability insurance, we'll talk all about these, but I want you to know disability insurance, if somebody becomes disabled during their working ages, workers' compensation, Medicare. We'll also talk about Medicare. This is really, really interesting. Medicare covers people 65 and older. It's a health insurance for elderly. So common features of these social insurance programs are mandatory contributions, and you have to have measurable and enabling events such as turning 65, such as becoming disabled, right? Becoming unemployed, retiring. Those are measurable enabling events. And benefits are not related to one's incomes or assets. So maybe I have lots of money saved up already, but I have my Social Security income guaranteed coming to me once I retire. They can't be like, oh, you have too much money already, we're not going to give it to you. So that's not the case. Okay. So let's talk about the general economics, how economic ideas apply to insurance markets. So why do we value insurance, right? What forces cause the insurance markets to fail as well? So we are going to talk about what we call adverse selection. So if those people who are more accident prone, more likely to get insurance, then the insurance markets may fail. So what happens to the social efficiency in the presence of moral hazard. We'll talk about that. So what trade-offs should we make in designing the best optimal social insurance programs? So central to this discussion, we have two important key concepts. Adverse selection, which means insured people, they know more about themselves, their own risk, than the insurer. So what if I'm a really clumsy person, which I am, folks, too much information, but I was at a wedding yesterday night and I fell while dancing, okay? So I am very clumsy. What if those who, I know I'm clumsy, but insurance people don't know that, right? What if only those who are very clumsy buy the insurance? Think about it. Second one is the moral hazard problem. Moral hazard is when you insure people against adverse events, and what if you encourage this, they suddenly engage in this adverse behavior? For instance, if I have full car coverage, right? And what if it makes me drive a little bit less carefully? Or I have a pickup truck, right? And then it has really nice security system. So what if it makes me a more aggressive driver? This is not related to insurance market, but having a vehicle that's really safe. What if I become a more aggressive driver? Or what if I bought an accident insurance? So I'm like, it's okay. I can just fall dancing on the dance floor. I blame my dress skirt. It was too long. I will see you in part 2. This was a quick review of the social insurance ideas and insurance, moral hazard, adverse selection definitions. In part 2, we will talk about why people buy insurance and what is insurance. Couple of things, folks. You're watching this video, hit the like button so it will be pushed in front of those people who are struggling in economics, trying to get an A in their classes and learn the world of economics. Number 2, subscribe to this channel. I'm tired of saying it, but subscribe so whenever I post a new video, you can, boom, watch it. I'll see you later. Take care.